Did you know the data shows that simply having access to the best deals is the number one driver of outperformance? And in today's episode, I will cover all three. Number one is the data, and then the two sources for you to get access to the best deals. So stick till the end. We cover the truth about search fund investors. And what the Yale University data really says is we're going to talk about something almost nobody in the ETA world wants to talk about publicly, and this is actual investor performance. So let me start with a little scene. Imagine you are at a very nice dinner after an ETA conference. On your left is a searcher who just raised their first fund. They've got the MBA, a deck full of Stanford charge, and they are convinced this is a cheat code. Look, historical IRRs in the mid-30s, MOICs at 4, 5, even 10x, maybe even more. How can this not work? On your right is a quietly successful LP. Doesn't have a Twitter account, doesn't have a podcast, doesn't really post anything on LinkedIn, but they've been writing checks into search funds, private equity, and venture for 20 plus years. The searcher is excited. The LP is polite, but slightly amused, because the LP knows something the searcher doesn't yet. This gap between the index and what real people actually earn, it exists in every asset class. In public markets, retail investors underperform the S&P 500. In venture capital, most funds don't come close to the VC as an asset class headline returns. And in private equity, median funds trail the top quartile by a mile. And even inside the S&P 500 itself, the pattern is the same. A tiny number of names carry the whole show. The so-called Magnificent Seven, Apple, Amazon, Alphabet, Meta, Microsoft, Nvidia, and Tesla, make up roughly 1/3 of the entire index's value. So when people say the market returned X%, what they're really saying is a handful of giant winners drag the average up for everybody. Most investors never own enough of those giants to truly feel that index return. They own the index story, not the index economics. And now, thanks to this Yale case, we can finally see the same thing in search funds. Today we are driving into the real numbers, straight from a Yale case study that analyzed over 1,192 investor-level observations across 23 funds. There is the idea of ETA returns, the Stanford index. And then there is what actual investors with real constraints, real access issues, and real allocation decisions actually get. Those are two different worlds, and that's why this episode really matters, I believe. Because if you're a searcher, you can't just say, I'll be one of the good ones, look at the averages. And if you're an investor, you can't say, I'll back smart people and the Stanford numbers will show up in my IRR. They won't. It doesn't happen automatically. Here's the real question behind this entire episode. What exactly do you have to do as a searcher or as an investor to get into the small group of people who actually earn those top-tier returns? Again, it's not really a theory, it's not a PDF, but I mean like the real portfolios. And that's what this Yale study quietly answers. It shows us how often people really win, how often they really lose, how much of the upside comes from a tiny number of outlier deals, and what separates the average participant from the ones who actually catch the griffins, those 10x plus outcomes that change everything. Rest of this episode, I want you to imagine you're that LP at dinner. You've seen the cycles, you've seen the hype, you've seen asset classes where the story sells one thing and the math delivers something very different. And as we walk through this case, we are going to do two things. Number one, we're going to zoom out and see how ETA fits into the broader pattern of investing across asset classes, where a small percentage of positions drive most of the returns, and where access, and behavior matters more than theory. And number 2, we're going to zoom in and get brutally concrete about what you personally must do as a searcher to give yourself a real shot at being in the top slice of outcomes. And as an investor, to build a portfolio that doesn't just survive, but actually captures the rare outliers that move the needle. Because understanding the numbers is just step 1, but knowing what to do differently because of those numbers is where the real edge is. Segment number 1, the illusion of Stanford Index. Let's start with a myth that drives the ETA gold rush. Since 2011, Stanford's Search Fund Study has reported IRRs in the mid-30s, around 4.5 times to 11 times. And every year, this attracts an entire new generation of MBAs, self-funded searchers, and investors flooding into the ecosystem convinced all you need to do is bet on a smart person and the returns will take care of themselves. But the Stanford data has a hidden assumption backed into it. It assumes investors have access to every deal, and it assumes they weigh from evenly. Nobody, not even the best ETA investors alive, can replicate that. And that sets the stage for the Yale study's number 1 insight. Almost no investor actually achieves Stanford-like results. Not because they're bad, not because they're sloppy, but because of a single structural problem. Your portfolio is never the index. It's just the deals you actually got into. Just like retail investors never actually match the S&P 500 because they mistime buys and sells, search fund investors don't match Stanford because they don't see everything and don't size bets perfectly. The segment number 2, the batting cage problem. Yale uses a brilliant metaphor. Imagine a baseball batting cage. The pitching machine fires the same pitches to everyone. Some investors swing, some don't, some bunt, some swing for the fences. Same pitch, different outcomes. And this is exactly what's happening in ETA investing. Investor A gets invited into a searcher's deal. Investor B does too. Investor C doesn't. Investor D gets asked but says no. Investor E gets in but writes only a tiny check. But investor F goes all in. Now, take this and scale it to 94 new searchers per year, then across thousands of potential LP opportunities. The data shows that simply having access to the best deals is the number 1 driver of outperformance, something I said in the very beginning of this episode. It's not modeling, it's not deal analysis, it's not even post-acquisition value creation, it's access. In this whole game, access is the edge. Who actually gets invited into the good deals? Who sees the real opportunities before they're shopped to the whole world? Who gets to swing at the pitches that could become griffins? That's exactly why this episode is brought to you by CapitalBad, the platform where investors back the next generation of business buyers. Think of CapitalBad as a way to step inside that batting cage on purpose. Instead of scrolling past headlines about someone buying a great small business, you're seeing the actual searchers, the actual deals, and the real opportunities to put money to work alongside them. On CapitalBad, you will find vetted searchers serious about ETA, not just tourists. You're going to see real acquisition opportunities, not theoretical case studies. And you're going to get access to deals you won't find in public markets or on crowdfunding free for all. It's a way to invest in the backbone of the economy, which is profitable small businesses. If you believe in backing builders rather than just betting on the next app or a token, check out capitalbad.com and start partnering with searchers who are out there buying great small businesses today. Again, capitalbad.com. Now, the segment number 3, the 2-stage bet that everyone ignores. Search fund investing has a unique structure. Stage number 1, you write a small check into the search. Let's say 25,000 to 75,000. This is a talent bet. You're betting on a person. And now we have stage 2. If the searcher finds a deal, you must make a second decision. Do you invest in the acquisition? And if yes, how much? And Yale shows that 36% of searchers never find the deal at all. That's a lot of 25,000 to 75,000 checks evaporating. But here's the brutal truth. The broken searches aren't the main problem. The main problem is missing the winners. We all know stories where a searcher found a shockingly boring B2B services business. Recurring revenue, strong margins, and a list of customers who never churned. Some investors said, not exciting enough. They passed. A few even rolled their eyes. Fast forward 5 years. The company tripled EBITDA. The searcher professionalized operations. They added one bolt-on. They sold to a strategic at the 12x MOIC. One LP put in 200,000 and made 2.4 million. Another LP who could have invested made nothing. Same deal, different decision, and very different life outcomes. And that's the thing. The winners often don't look like winners when they first show up. And the Yale study proved it clearly. There are very few superior deals, but they matter more than everything else combined. In fact, only 2% of investments ever become 10x plus outcomes. But the 2% drives a huge portion of entire asset classes' returns. And only a handful of investors consistently get into those deals. This is the same pattern as venture capital unicorns, or the Magnificent Seven dominating the S&P 500, or private equity firms where one fund in a decade makes the whole franchise rich. You miss the top outcomes and your portfolio will be average. You catch one and suddenly you look like a genius. Your ETA success is determined less by avoiding mistakes and more by making sure you never miss the few rare great deals that come along. It's not so much about the defense, it's about the offense. Most people don't lose because they invest in bad companies. They lose because they didn't invest in the great ones. That's the silent killer of returns. That's the secret the top ETA investors quietly understand, and that's the part the Yale data exposes for the first time. Now, the segment number 4, the MOIC distribution no one has ever seen before. Here's where the case gets spicy, we can say. Yale published what is probably the first publicly shown distribution of actual investor MOIC results. And it looks nothing like people imagine. 58% of investor outcomes fall below 2x. And when you look at for a legendary ETA home runs, only 2% of investments produce 10x plus returns. That's the same probability as a college football player making it to NFL. So let that sink in. If VC has unicorns, then ETA has griffins, the mythical creatures that are half eagle, half lion. They're rare and majestic. And just like unicorns in venture, griffins in ETA are the only thing that makes the math work. If you don't catch them, your portfolio will be fine, but it will not be Stanford level amazing. And Yale shows that only 5 out of 23 funds in the dataset had griffin exposure. What is your likelihood of getting access to those deals? Because I guess this is what you want, and access to these extraordinary deals from searchers and business buyers. How does one do it? In ETA, people obsess over modeling, diligent checklists, cold emails, and deal structure. But the investors and operators who consistently catch the winners, the griffins, again, understand something deeper. Opportunities don't just appear. They flow toward people who stay top of mind. Sellers talk, LPs talk, searchers talk, operators talk. The people who attract the best deal flow aren't always the smartest, but they are the most visible, the most trusted, and the ones who communicate with clarity and consistency. And that's where Spacebar Studios comes in. Spacebar is the quiet engine behind some of the smartest operator and investor brands you have seen. They're a done-for-you newsletter team that handles everything, takes strategy, writing, design, distribution, and analytics. They turn all these insights into consistent compounding attention, the kind that makes opportunities find you. This is how reputation compounds. This is how deal flow compounds. This is how you avoid missing the winners. And here's the wild part. They are guaranteeing 10,000 subscribers in your first 90 days for your newsletter, or you don't pay. If you want to build a name that attracts the best deals, the best operators, the best LPs, go to spacebarstudios.co/inquire and book a free call, have a conversation with them, and see what they can do for you. Because again, they are guaranteeing 10,000 newsletter subscribers in your first 90 days, or you don't pay. Now, the single biggest insight from the case: funds that got at least one 10x plus deal dramatically outperformed those who didn't. Not by a little, but by a lot. Even more interesting, the investors with griffins not only won big, they also lost less. This implies a real phenomenon. There is a tier of elite ETA investors with superior access, superior selection, and superior allocation. The case hints at why they get first calls from the best searchers. They are invited into deals that others don't even see. They can write large checks. Their name helps searchers win competitive process deals. They may help companies perform better. They have built a brand and reputation that compounds over time. It has a clear hierarchy, and that hierarchy absolutely shows up in investor returns. And you can't spray and pray your way to success, as people say. Just make a ton of bets, you'll catch a griffin. Because Yale tested this. They ran a regression, deal count versus lifetime MOIC. The result? No correlation. The biggest winners are so rare and access so concentrated that simply doing more deals does not guarantee you'll hit home run. If you're an entrepreneur thinking about raising a search fund, Yale gives you two sobering stats. Only 51% of searchers make any money. Only 20% of all people who start a search end up with less than 3x MOIC outcome. This is still an amazing career path. You can't find a biggest fan than myself. Because I don't know about you, but with a great team and excellent thesis, you can really be in the group with accomplishes the 3x MOIC or higher outcome. But again, most portfolios will land between 2x and 3x. And this is still great, equivalent to 15 to 25% IRRs over 5 years. But let's cut the noise. You cannot rely on the Stanford index as a realistic expectation. It's the theoretical max, not the achieved average. And unless you have elite access, you will never match it. So the next time someone tells you they're going into ETA because Stanford shows a 30x plus IRR, send them this episode. ETA is an incredible path, but only if you understand the real odds, the real dynamics, and the real power lays at play. And for both investors and entrepreneurs, the message is the same. Respect the math, respect the rarity, respect the griffins, because in this world, your entire financial future may depend on catching just one deal. This is Holdco Builders. My name is Mick. If you have not subscribed or followed the podcast yet, please do so, because there are so many more episodes like this coming in the future, which will hopefully help you become a world-class acquirer and investor. Until next time, take care and see you very soon.